That's right, everyone. I finally sold some Apple stock. Now, this may come as a shock because I am a self-proclaimed Apple fanboy. I have the iPhone, I have MacBooks, I have a Apple Watch, I have all the Apple stuff. I love their products. I love the stuff they make. But Apple is now getting to a price of, well, it's expensive. It's now at a price of almost $200 per share. And a lot of the valuation metrics have moved up a lot over the past year. Now, I don't want to get you too concerned. I sold Apple, but I sold it out of the Story Fund, not my main portfolio. So the Story Fund did have a position in Apple, but it was a pretty small position, all things considered. We'll go ahead and look at a screenshot here of what this looked like. This was my Apple position. So the portfolio used to look like this, with Apple being a $2,400 position, around $1,600 in the green. And I sold entirely out of it and put that money into Netflix. So that was the basic transaction. I sold some Apple shares and I bought some Netflix shares. And now the Story Fund looks like this. It's the exact same except Apple's missing. We have Amazon, Netflix, Google, Microsoft, and S&P Global. 5 extremely high quality companies. Now, we're going to be going over this transaction. I'm going to be looking at the valuation of Apple and some of my concerns and why I sold it out of the Story Fund and continue to hold it in the passive income portfolio, as well as we're going to be looking at Netflix and why I think Netflix is a bit more attractive than Apple today. So we'll be going over all of that. Now, we also have some other big news. Netflix, for the first time ever, did this massive drop of their most watched series. And it was any series watched over 50,000 hours, which is almost all of their stuff. So Netflix just revealed how much all of their content's watched. This is a level of transparency that we haven't seen from any streaming company. Netflix is the only one doing this, and it gives some interesting insights. We're going to be looking at the top 5 shows, what all of these have in common, as well as a breakdown of how this transparency, what this reveals about Netflix, the company, and why some analysts are saying now that this is actually a positive thing for Netflix. Now, we also have some more news about Cosmix. It's now official. We're not just seeing rumors. We can see people lining up like crazy to buy McDonald's new Starbucks knockoff. It's Cosmic and they sell drinks. And we actually have the entire menu here in HD. We're going to be looking at the pricing, how they price this against Starbucks, and I'll be going over my thoughts on McDonald's now competing directly with Starbucks. And then finally, a lot of people complain, Joseph, you don't talk enough about stocks you don't own. You're only talking about the stocks you do. Well, in this episode, I thought it would also be interesting to go over a stock I do not own. That company is Pfizer. Pfizer just recently had their earnings report, and this is a company where I'll explain why I would not buy the dip in this situation, and why Pfizer and companies like Pfizer do not meet the qualifications of what I consider to be an attractive investment. So we have a lot to get to. Let's go ahead and jump right in. Now, let's first go ahead and address the Apple sale. It is true that I sold some of my Apple stock, but I want to be clear about something, in fact, very clear about this. I sold Apple entirely out of the Story Fund. The Story Fund is my smaller, secondary portfolio. It is far more concentrated. It has $180,000 of value concentrated now into only 5 companies, with the majority of that being concentrated into these 3 positions, Amazon, Netflix, and Google. I sold out of my small position in Apple, which is around $2,500, and put that money into Netflix. Now, Apple was a winning position. You can see right here that I was in the green at the time I sold the company. In fact, it was a big winning position. Obviously, Apple has done really well. So this wasn't a sell out of desperation or capitulation. This was a sell for different reasons. But again, I want to stress the point that I sold Apple out of the Story Fund. I did not sell it out of the passive income portfolio. If I load in the passive income portfolio, this is what it looks like. It's a much larger portfolio. It has $582,000 of value, around $140,000 of gains. It's done really well. And the strategy of the passive income portfolio is slightly different than the Story Fund. I hold companies a little bit longer in the passive income portfolio. So I still have, in the tech category here, if we can load in, I have Apple right here. I've not sold a single share. I'm still holding $56,800 of it. It's $27,900 in the green. So you might ask the question, why did I sell out of Apple in the Story Fund and not the passive income portfolio? And that's a good question. If we load back into the Story Fund here, The reason that I decided to make some changes with the story fund is I felt like there was a lot of overlap between the story fund and the passive income portfolio. In fact, I was feeling like they almost lost their unique identities. A lot of people were saying, look, you have Microsoft in both portfolios, you have Apple in both portfolios, and you have S&P Global in both portfolios. So there's a bit of overlap between the two, and I'm trying to move in a direction of making them more unique. Having the story fund be a little bit more aggressive, a little bit more risky, I guess, more concentrated, but overall just a more aggressive, growth-oriented portfolio than the passive income one. And that's the big reason I sold Apple. I simply wanted to make the portfolios more unique, and I thought that Apple is not in a position to be overly aggressive of a holding. So if we look at Apple and we compare it to what I bought, Netflix, we can take a little bit of a comparison here. Let's go ahead and just take a look at Apple first. Apple is now at $196 per share. It's pushing $200 per share. That's high. That's a pretty high price for Apple. And I'm saying this as someone that's long the stock. I still own a lot of it. But if we look at the price here, it pushes up all the metrics of the company. For example, the PE ratio of Apple is now at a 29.5. Now, to me, that seems a little expensive because I was buying Apple in the low 20s. In fact, I bought it below a 20 PE ratio. That's when I was buying $20,000, $30,000 of Apple, was when it was a lot cheaper. The earnings have grown a lot and the PE ratio has expanded. The free cash flow yield, again, has gone down, making the company more expensive. I remember buying Apple when it traded above a 4.5% free cash flow yield. 4.5. Now it doesn't even trade at a 3. So the free cash flow yield has gone down, the PE ratio has gone up, the price has gone up. So overall, the company's looking a little bit more expensive on a pure multiple basis. But I want to add more context to this discussion because it doesn't just matter what the company trades for today, it matters what the expected growth is over the next 5 years. If you look at a company that's trading at a 30 PE ratio, that doesn't really tell you in and of itself if the company's expensive. Because maybe the company's expected to grow really fast over the next 5 years. In that case, 30 PE ratio is not that expensive. But if the company's going to have average growth or even slow growth, then a 30 PE ratio becomes very expensive. So the determination of whether or not a stock is expensive or cheap is not just on the PE ratio alone or the free cash flow yield alone. It's on these metrics in combination with your growth expectations. When you combine both the growth expectations and the multiple of the company, then you can determine whether or not a stock is really expensive or cheap. So let's go ahead and take a look at Apple. We know based off of the metrics alone, it looks like it's on the high side. A low free cash flow yield means that you're not getting a lot of cash flow for what you're paying, and a high multiple on the PE ratio means you're paying a very high multiple based on its next 12 months of earnings. But let's go ahead and take a look if Apple's expected to have tremendous growth over the next 5 years. We can take a look at the analyst expectations of growth. I have it pulled up here. Maybe I can zoom in a little bit on that. There we go. This is more clear. So we have Apple pulled up here. And if we look at 2024, do you see the problem here? Apple is expected to grow by 7%. This is their earnings per share growth. So EPS growth of 7% next year. That's not a lot. But then it could speed up in 2025, right? Well, it doesn't really speed up all that much, up to 8.5. Now, again, this is analyst expectations. So obviously this isn't going to be 100% correct. They're making their best guess. Maybe Apple will grow much faster than 8% in 2025. But do we have any reason to believe they will? Is there anything outside of what we're looking at here that suggests they will? I don't know if Apple's going to be growing 15% or 20% earnings per share. I think these analyst expectations are pretty fair. And then even going on to 2026, they're expecting 10% growth and 12% growth. I assume the analysts are speeding up the growth because the comps or the year-over-year comparisons become easier in 2026 and 2027. So overall, what I see in terms of expectations is pretty tepid growth, slow growth from Apple over the next couple of years in their earnings per share. If we look at their revenue growth, this is the consensus from analysts, it's expected to only eke out 3.5% growth in 2024. That is slow. That's barely above inflation. So Apple's basically at a point where it's like a consumer staple growing along with inflation. In 2025, they're expecting a moderate speed up to 5.7. In 2026, 6.9. So the revenue growth is not that fast either. We're seeing single-digit revenue growth. And again, when you combine that with the earnings per share growth, that looks like a slower growing company. So we have slower growth expectations in earnings per share and the revenue, which again, in and of itself is not too bad of a thing. But when you combine it with the multiple that Apple trades at, a 30 PE ratio, and you combine that with slower growth ahead for the next 3 or 4 years, it just looks like right now is not the best time to be buying into Apple. It seems a little bit expensive. You have a higher valuation, slower growth expectations. Now, obviously Apple is a great company that's extremely defensive. It's being priced as a consumer defensive or a consumer staple. I think that's appropriate. I think people are so addicted to their iPhones, to their Apple Watches, to their AirPods, that I don't see destruction happening to the company. So I'm not bearish on Apple. I don't think the company really needs to be sold right here. But if we look at other opportunities, I think there may be other more attractive opportunities right now. Let's go ahead and take a look at Netflix here. If we look at Netflix, Netflix is trading at almost the exact same valuation metrics across the board. For example, the forward PE ratio of Netflix is 28.9. Apple's was 29. So they're trading over the next 12 months on the same earnings multiple. But then we even look at the free cash flow. Adjusted for stock-based comp, the free cash flow yield is nearly identical. So today, Apple and Netflix trade at almost identical valuations if you're valuing the company over the next 12 months. But Apple and Netflix have a different total return profile over the next 5 years. Very different. Right now, Netflix trades at the same multiple as Apple, but the expectations of future growth are dramatically higher. Let's go ahead and take a look here. What we're looking at here is Netflix's earnings per share projection by the analyst consensus. And again, if we look at Netflix, we look at 2024, it looks very different than Apple. Netflix is expected to have earnings per share year-over-year growth of 29.94%. So basically 30%. Now compare that to Apple. We go back and look at Apple's. The same year, the year-over-year earnings per share growth is expected to be 6.85%. So roughly 7% versus 30%. Then we have 2025. Analysts are predicting 23% growth for Netflix. In 2025, again, analysts are expecting 8.5% for Apple. So what we have here are companies that are trading on the same earnings multiple of 34 PE, but Netflix is expected to grow roughly 3 times the speed. Now you may say that Apple deserves a higher PE ratio because it's a more defensive and more predictable company. But I would argue with that point. I actually believe that Netflix is very defensive, very predictable, and I've believed this for a long time. In fact, if we look at a paper that I wrote, I published this back in December 1st, 2022. I posted on my Patreon Discord, and it was an update on my thoughts on Netflix. Now keep in mind, December 1st, 2022 was still when there's a lot of doubt with Netflix, a lot of confusion. The price was about half of what it is today, or it was a lot less than what it is today. I just want to read one paragraph out of this paper. The damage to Netflix story over the past year is real. Investor confidence has been shaken. Even Bill Ackman purchased into Netflix to buy the dip and quickly sold out only 3 months later when Netflix had another disappointing quarter. He now stated that the stock is, quote, too unpredictable for his concentrated portfolio. This is where I continue to strongly disagree with both the market and Bill Ackman. I don't think things are so bad for Netflix, and I don't think the company is that unpredictable. In fact, I think Netflix is one of the most predictable companies in the market. I believe Netflix remains one of the most clear and predictable long-term winners in the equity markets. I have said for years that I believe Netflix is a predictable winner, one of the most predictable companies in the market. And in my opinion, I don't think they just won the streaming war. I think they've had this thing won for years. It's literally been years that they've been the winner. So when we look at predictability and try to judge that between Apple and Netflix, there's different things to consider. One of them is that Apple is a very predictable company. It's a consumer defensive, but Apple faces a lot more regulation risk than Netflix. Netflix had some risks with the writer's strike and the Actors Guild. Those strikes put a lot of pressure on them, but that's behind them. And I believe Netflix had pretty good terms with the conclusion of that. When you look at the regulation risks that Apple faces, well, we saw a preview of that with Google. Google just lost a big trial against Epic Games, saying that they're a monopoly. Apple faces intense regulation from the EU. The next step from the EU is likely to open up the App Store monopoly, make it so you can install other stores on the iPhone across Europe. This is a little bit of a weakening of Apple's overall moat. So I think Apple does face a lot of regulation risk that Netflix doesn't face. And in terms of future growth, I believe both companies are going to continue growing. Apple will continue growing by doing lots of share buybacks, running their economic moat. All the economics of it are great. But Netflix is going to grow through organic subscriber growth and pricing power. The company's shown that it has a lot of pricing power, and I believe it's set up really well right now for a long, durable runway of growth. So between the two companies right now, I believe that Netflix has a better overall return profile than Apple over the next 5 years. Now, of course, nothing's guaranteed in the future. I could be wrong, so if you're buying into these companies, make sure you do so at your own risk. Now, moving on, we have some big news out of the streaming world. In fact, this does regard Netflix. Netflix just did this massive data drop of streaming data. In fact, what they did was they published this huge report that had thousands of their shows and how much their viewership was for each show, each film over the past 6 months. So this is a new semi-annual report showing everything that was watched on Netflix and how many hours was watched. This is a level of granularity that no other streaming service has shared. So now we have a bunch of data, and all the analysts and a lot of different people are trying to make sense of this data. What type of conclusions or insights can we draw from this big data dump? Well, one of the things that people noticed was Netflix's biggest hits. The top 5 hits over the past 6 months was The Night Agent, Season 1, Jeannie and Georgia, Season 2, The Glory, Wednesday, and Queen Charlotte, A Bridgerton Story. So these are the top 5 most watched. Now, one takeaway that I had from this was that every single one of these are Netflix originals. Netflix produced all of these shows, the top 5, and the entire list included licensed content as well. What this proves is that Netflix is decent at creating shows that people watch, their original content, and they're good at promoting shows on their service that people watch. So a lot of people like Netflix originals, which I view as a positive thing for Netflix. If all top 5 were licensed content from ABC or, from Disney or HBO, if it was all like The Wire and different shows that they didn't own, I would think that's a little bit concerning. With how much original content they're creating, if all the top shows were licensed content, I think that would be a bit concerning. But seeing it all as original content, I think is only a positive thing. Another thing I'll point out, just as a side note, a lot of people are pointing out how The Night Agent Season 1 beat out Wednesday. And they think, wow, how did The Night Agent beat out Wednesday when Wednesday was so talked about online? It had so much hype, so much buzz. Well, it really didn't. This is the first half of 2023. Wednesday had already been out for 2 months prior to this report being published. So what we're seeing here is that Wednesday was still number 4, even though it had already been out for 2 full months. So a lot of the people that watch Wednesday were already done watching it. Wednesday crushed The Night Agent. It crushed all of these shows if the report started prior to 2023. So this is more of an issue with when the exact films or shows were released and when the report happened. But just to be clear, Wednesday was a much bigger show than The Night Agent, if you started from when the shows actually aired on Netflix. Now, as analysts try to weed through all of this information, again, they're drawing a lot of conclusions. We have Barron's here on the front page saying that Netflix has revealed viewership content for the first time. The most significant revelation was the strength of its original programming, which provided all 6 of the most watched programs in the first half of the year. It's a good sign for Netflix, which has previously faced questions about how much money it spends on content and how it affects margins. The new data should bolster its case that original programming gives an edge against competition. So now that the analysts have a hold of this data, they're actually saying that this means that Netflix is in a stronger position than previously thought. Because again, we didn't know how original content on Netflix really stacked up against Disney, against HBO. Now, one of the things I'd love to see is Disney publishing the same report with Disney+. How much are their series being watched? How much is Andor or Loki or She-Hulk or Mandalorian Season 3 actually being watched, and what does the engagement look like? If I had to guess, I think that Disney is going to be very reluctant to ever publish this same report, because I think it would reveal to the public that Netflix originals are being watched far more than Disney Plus originals. I think that's the case right now. Now, moving on, we finally get to the reveal of McDonald's CosMix. We saw a little preview of this of someone that snuck some pictures on Twitter, but we actually have more high resolution images of what this actually looks like. In fact, the Wall Street Journal is now reporting on this. If you've been left out of this news, McDonald's is starting a new concept, a new chain called CosMix. And from what I can tell, this seems to be a direct competitor to Starbucks or Dutch Bros, any of these drink places. You can look right here and it just looks incredible. There's already something I noticed, which is they have 3 cars taking orders at the same time. In fact, I think this might go up to like 5. So McDonald's is just going all out with the drive-thru. Everybody goes through drive-thru, they know the morning routine, and they're making a ton of ordering stations for their first couple concepts here. So 3 cars ordering at the same time. You have the same menu there. Let's go ahead and read about this a little bit. They say the Wall Street Journal checked out CosMix on Monday morning, plunging into a parking lot filled with traffic cones, police tape, and officers managing a growing line of cars. About an hour and 40 minutes later. An hour and 40 minutes. What an opening to a restaurant, to a new drink concept. People are waiting almost 2 hours to get a fun drink in the morning. McDonald's said that CosMix is in test mode for now, and the company plans to build around 10 additional locations in Texas in the first part of 2024. So they're testing it out. It's still in beta, but they are running actual restaurants now. The company said it's evaluating how different drive-through configurations can speed up services. This is one of the things that's just incredible about McDonald's. Now, I don't hold this stock, but McDonald's is truly one of the most innovative, incredible, scaled companies ever. It just changes and iterates and improves over time, and you have to give them credit for what they've created. It's just incredible. They are crushing other food companies. It's like you got Microsoft with software companies, and then you have McDonald's with fast food. They are just the leader, the king of all fast food. Now we go into the menu a little bit. They say don't expect fries. The beverage-heavy spread is closer to a coffee chain like Dutch Bros or Starbucks. So like I said, this seems like a direct competitor aimed at Starbucks or Dutch Bros. And the pricing of it is just below Starbucks pricing. I was doing some price comparisons looking at it, and they are pricing just marginally below Starbucks, but they aren't doing a full assault on Starbucks where they're pricing for like half the price. But these prices are just a bit below. Now, they also posted the menu online, so we get a higher resolution of all the drinks here. And it's the same type of thing where you can click on one of them, and then you have customization options just like Starbucks. So one of the fun parts of Starbucks is you can customize your drinks like crazy. Now, CosMix does not have as many customization options, so it's not quite as versatile, but there's still a lot of customizations. You can do a lot with your drinks here. And of course, they're integrating all of that into the digital app. So it seems like a nice system they have here. When I look at all of this, my biggest concern as an investor looking at companies like CosMix and Dutch Bros and Starbucks is overall the drink category. I feel like the drink category, specifically caffeine, is becoming very, very saturated. Think about all the companies we have. We have Starbucks, the leader, that there's literally jokes about Starbucks being everywhere. In fact, The Onion wrote an article saying that Starbucks opened a Starbucks in a Starbucks bathroom. And that seems like it's true. Everywhere you go, there's a Starbucks. So you have that option. But then you also have Dutch Bros, another chain that's focused more on the energy drink side, more sugar side. That's opening up everywhere. But then you also have energy drinks. We've seen the rapid success of Monster Beverage being followed up by Celsius, another energy drink company that's aimed at a more healthy take on it. So we have lots of energy drinks growing like crazy in sales. And then we have McDonald's, the king of fast food, opening up their own drink concept, which they have the ability to scale this up quickly. McDonald's could open up thousands and thousands of locations a year once they figure out the concept. What this makes me believe is that at some point there needs to be diminishing returns with drink companies. There's just so many of them. And again, I can continue to go on. There's Prime with Logan Paul, the energy drink company. There's so many competitors seemingly every single year entering into this category. As an investor, it seems like the competitive intensity of caffeinated beverages has literally never been higher. So for me, I'm going to hold off on investing in any of these companies because I feel like there's just too much competition in this category. Now moving on, I want to talk about Pfizer stock. Pfizer just recently reported their earnings today. The company's down a little bit after hours. Now, a lot of people say, Joseph, you're always talking about companies you own, the compounders, the ones that you're buying into. You don't spend enough time talking about other companies. So I thought it would be interesting to address one company that I don't own and go over the reasons that I don't own this company. Simply put, the reasons that I would exclude it from my investment universe. Now, I have no ill will on Pfizer. I'm not trying to bash Pfizer investors or anything like that. This is simply to look at the type of companies I own and the type of companies I don't. First of all, Pfizer just reported their earnings report today. The shares are down around 8% after the report because they projected that sales would be $5 billion below what Wall Street previously expected. So they moved their forecast way down. Wall Street repriced the stock to reflect that new adjustment lower in their future projected guidance and earnings. So that's the reason the company's down. But that's not the reason that I wouldn't buy the company. It's not because of one bad quarter or even one product or something specific happening. The reason that I wouldn't buy Pfizer is because of an overall lack of predictability. That is the biggest thing I'm trying to stress with the stocks that I'm buying and the stocks that I'm not buying. The ones that I'm buying are overall predictable stocks. By my judgment, they are the most predictable stocks, the most predictable winners. When we look at Pfizer, this is a company that trades at a very low valuation. So if you're a value investor, you might buy in believing that you're getting good value. It trades at a 9 PE ratio. That's a lot cheaper than a company like MasterCard. A company like Netflix, that's a pretty cheap PE ratio. In fact, that's much lower than any other company that I own. I own no company that has that low of a PE ratio. It trades at a 5% free cash flow yield. So again, it's cheap on a free cash flow yield basis as well. If I bought Pfizer, it would be the cheapest company that I have in my portfolio. But it would also be the one that I am the most concerned about losing money in. If we dig into the financials of Pfizer, we can clearly see why this is the type of company that I don't like to invest in. I'm looking for compounders, companies that will grow their earnings, grow their revenue, grow their cash flows, and keep that growth over time. The problem with companies like Pfizer is that they'll grow for a time period, like it did during the pandemic. It had a huge increase in demand, but it gave up all of that growth. All of it's completely back to where it was before, and so the stock is right back to where it was before. Now, if it was able to grow like this and continually keep the growth predictably, that's a different story. But that's not what this company does. It is not able to continue compounding its gains over and over again. It is growing in spurts and then leveling off. And over the past 10 years of financials, the EBITDA, the cash flow, it almost looks entirely flat. So you have a company that trades at a low PE ratio because there's almost no growth. You can compare this to any of the companies that I'm investing in, and all of them are able to sustain their growth. Costco paints an entirely different picture. Continued growth year after year. With companies like MasterCard, we see the same thing. This company grows quarter after quarter, year after year. It has a little bit of volatility, but over time it's going to continue growing. Every single company that I'm investing in, you name it, is going to have a revenue chart that looks more similar to this type of growth than it does to something like Pfizer. So Pfizer is an example of a company that's cheap for a good reason. It trades at a low PE ratio and a high free cash flow yield because it has almost no growth and no predictability. And it's certainly not the type of company that I would invest in. That's all for this episode. See you in the next one.